Hello, my name is Eddie Tofpik. I'm Head of Technical Analysis and Senior Markets Analyst at ADM Investor Sales International Limited. And here is your weekly technical analysis of LME 3-month nickel, zinc and tin. However, before we start, I just wanted to let you know that no AI, that is artificial intelligence, was ever used in the composition, production or recognition of any of these patterns, levels, analysis or any related items on these, my charts. This was all authentic intelligence, all my own original work, as I think you deserve to have that. So with that,
LME 3-month nickel. In late January, we saw the market move from a January-based ascending wedge pattern straight into another similar setup. Originally, it was a bright red February-based ascending triangle or ascending wedge pattern that morphed later on into what we have now, a shallow, bright red, now breached and broken bull channel, currently 17,275 to 18,515. Now February, March and now early April made this bright red bull channel, but it also made another pattern, an earlier pattern also broken on the upside. A late February to mid-April dark blue descending expanding wedge pattern. This one had the required number of touches on each side, and with the significant break higher, I decided 2 weeks ago to lay out some targets for the move up. Thus we had a primary target X, which is up in the 18,835 area, close to the August 2019 high at 18,850, and a secondary harder to reach target X1 up in the 19,135 area, close to the highs earlier of this year. The cause of this move up, well, that can easily be seen as at the turn of March into April, prices became squeezed between the dark blue upper trend line overhead, currently at 17,085, which had previously been helped by the declining green short medium moving average, currently at 17,595, and from below by the rising bright red lower bull channel line. Thus, it was not a surprise that we saw such a move higher, as something had to give way, and it was the turn of the dark blue upper trend line and green short medium moving average. For a while in mid-April, prices became held down by the bright red upper bull channel line and on a closing basis by the July 22 low. But late last week, the market broke higher, with seemingly only the September 22 low overhead at 20,045. Though the market is taking its own sweet time in getting up there. It nevertheless now raises some interesting possible targets for this break above the bright red bull channel. A primary target X2 up in the 19,745 area, and a secondary hard to reach target X3 up in the 20,485 area. I'll be interested to see how these now work, especially if we resurrect the idea of the whole December 2025 today action as a bullish halfway hesitation pattern, and that would be something to see. LME 3-month zinc. We're still left here, as I said last week, with one big old pattern, and it's a bigger one, and a pattern about which I've spoken about before, and then one newer pattern. Now the big old pattern is the bright red May 23 to April 25 bullish Andrews pitchfork, and especially the middle time, which is currently at 34.28. We reached the middle time late 2 weeks ago, and we have since hesitated around it before moving lower yesterday and today. In doing so, prices overcame a pair of resistances that became supports and are now seemingly becoming resistances once again. They are the 50% Fibonacci line, the March 20 to March 22 move at 33.29, a support right now, and the 50% Fibonacci line of the April 22 to May 23 move at 33.77. And that's a resistance right now. Then we have the second newer pattern, the dark blue middle time, currently 34.50 of the April 25 to March 26 bullish Andrews pitchfork, which seems to have been part of the reason for the hesitancy we've seen. So, what have we on the downside that may slow or even halt the decline? Well, apart from the 50% Fibonacci line at 33.29, we have a problem with a possible, not problem, but a possible congestion zone from about the October 24 high at 32.84 up to the December 22 high at 33.39. Now there are various levels in between, but I'd rather rely on the congestion seen between these two levels over late January through to early March. Meanwhile, on the upside, well, apart from this hesitancy, we seem to be below it at the moment, and that is it basically between where we are now and the high made back in January at 35.75, and the February 2018 high a little higher up at 35.95. LME 3-month tin. In the big picture, the market here since December last year is moving in between the bright red middle time below, currently at 41.155, and the bright red upper time above, currently at 58.570. And that's for the one big old pattern, still even now dominating this market. And that is the bright red, shallow, big, old 2020 to 2022 bullish shift pitchfork. A pitchfork that is still in operation 4 years after it was created. In the time of its operation since December last year, we have seen the creation of a lopsided head and shoulders top that failed, a double bottom that worked, and a double top that also failed. And most recently, a dark blue mid-March to late April bull channel, currently 59.05 to 54.180, which you have only just exited out of on the downside yesterday. Indeed, I said 2 weeks ago, and I quote, I would look closely at the 2022 high at 51.005. This may now look may not now look that great, at a great congestion as at a first glance. But it was instrumental in making the center of the double bottom in mid-February, and I would thus not ignore it. However, we also have some Fibonacci levels for the whole of the 2026 move at 47.595, 47.595, 49.775, and 51.960. End of quote. Yesterday we closed back down below the 50% Fibonacci line at 49.775, and we are now heading down to test the green short medium moving average below, currently 48.420, and maybe the rising mauve medium moving average, currently 47.390. Thus, it would seem appropriate to lay out some potential targets below for the breakdown through the dark blue bull channel. Hence, a primary target X is down in the 48,200 zone, so not too far, with a secondary harder to reach target X1 not too far below, down in the 47,250 zone, and a third tertiary, much harder to reach target X2 down in the 43,235 zone. We shall now see if these downside targets are worth the effort in defining them.
Thank you for watching and listening. This weekly broadcast gives the essential market patterns and consequences. Please be aware of the risk disclaimer posted both at the front and at the back of this broadcast. Copyright is Eddie Tofpik and ADM Investor Services International Limited. And here comes the final important bit.